focus. Ideation, innovate, enable. Reliance Mutual Fund and CNBC TV18 present Mutual Fund Day, Mission Prosperity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Retirement is a key life event for all of us. Growing incomes, increasing investment opportunities, and financial awareness have made it possible for senior citizens to be financially independent. But with inflation and rising cost of healthcare, senior citizens should continue to look perhaps for different avenues of income generation along with savings. Hello and welcome to this special show, Mutual Funds Day Life Hacks. Today we are going to be discussing investment options for the retired and those who are about to retire. To help us do that, we have with us in our studios Mr. Arun Sundaresan, Head of Product Management at Reliance Nippon Life Asset Management, and Harshvardhan Roongta, Principal Financial Planner at Roongta Securities. Gentlemen, thank you so much for being with us. It's a very important, piece of the puzzle, the personal finance puzzle that we're here to discuss today. And I want to start by getting some opening thoughts. Typically they say, the earlier the better. You should start thinking of retirement even when you're 30, 35, so you can start creating that corpus. But what's the first thought that comes to your mind, when you're thinking retirement and you're thinking about starting to plan for it? Why don't you start off, Mr. Sundaresan?
Retirement is not just about old age. So retirement planning is not about you're about to retire and then you start thinking what to do. And it is not just about how much corpus you have when you retire and what do you intend to do with that. It has to start right at the age of probably 30, 35. The earlier the better. In my view, retirement has two phases. One, what we call as the accumulation phase, in which you have to make all efforts to ensure that you have a huge corpus by the time you retire. People talk about a lot of things. You will have to fend for yourself, rising cost, exigencies. So many things happen after retirement. You need to have a huge corpus. And second phase is after you retire, how do you utilize that? So these two things are very critical. Unless well thought of, well executed, it's going to be very difficult.
Okay, absolutely. Harsh, your thoughts on this?
So, if you look at a typical lifestyle of an individual these days, why it is becoming even more necessary, because people are getting married late. So we're looking at people getting married about 30 years of age, where earlier the marriage used to happen at about say 25 or even earlier than that. So if you're getting married at 30, you're going to have a child possibly at 32. Okay, and that child is going to turn and is going to require money for his higher education exactly when you're going to retire. So when you do that calculation, you're going to require to fund your children's education at the time when you're sitting at the brink of retirement yourself. Or there is going to be a marriage expenditure at that point in time. So what is essential now is there are a couple of things that are going to happen for sure. Okay, one is taxation in your life is a certain. There's nothing that you can do about it. So you know about it, and then there is accordingly there is a planning that goes behind planning your taxes. On the other hand, if nothing adverse is going to happen to you in your life, you're going to definitely retire. Because that's a milestone you're going to definitely reach. Now, if you know this, that you're going to retire at one age or at one point in time where you're not going to be able to generate any income for yourself, how are you going to fund for yourself? Now, that question when it hits you, as and when it hits you, unfortunately it hits people when they are about to retire. By then it's already late. However, if it hits you much earlier in life, you can invest a very small portion of your money and accumulate a large corpus for your retirement.
Absolutely. So two aspects to it, as we've discussed. That one is the accumulation stage, which the earlier the better. Second is when you're actually upon the verge of retirement and what needs to happen there. Now the concept of inflation becomes increasingly important over here, because we know that whatever we are even earning while we're in our sort of accumulation stage, even there inflation will play a part. More so when you are retiring and you're trying to do a sort of a cash flow understanding about how much money you need for the next 10 years. Again, inflation. So Arun, how to factor that in and how to sort of keep this in mind?
So please understand that there is nothing fixed. So you may be under the impression that any fixed income, any fixed deposit or anything gives you fixed returns and therefore you're safe. But the other variable, which is inflation and so many other, unforeseen things, all these are not in your control at all, right? Therefore, what matters to you is, are you able to beat that? Are you able to generate real returns so that you don't outlive yourself? So if you don't do that, there could be quite a possibility that by the time you reach 70 or 72, 73, you outrun whatever you've accumulated all this through your hard work.
Absolutely. And talking of planning, I think once you are at the retirement age, maybe the first step is first to figure out what is your requirement, whether you have monthly income or not, whether you require a product that will generate some sort of monthly income. There's this whole cash flow management issue, as in how much can I really spend, how much sort of, how do I sort of balance my income vis-a-vis my expenditure. So Arun, what's the first step? How does one start with the basics there?
Please understand simple mathematics. You just have to put the numbers. The difficult part is to figure out where to get that. Suppose I know that this is what I need, these are my aspirations for which I need at least 9% return, whereas my fixed deposit is giving only 6.5%. Where do I go for that extra return? That's where the challenge comes, and that's where experts that
is exactly why we have the two of you wonderful gentlemen on the show.
Yeah.
Because we'll take a break, and that's exactly what we're going to attack on the other side.
Right.
That once you know what you actually need to get through the 20-25 years post-retirement, how do you go about ensuring that there's some sort of income generation and that you're completely covered for your remainder years? The conversation continues on the other side.
Reliance Mutual Fund and CNBC TV18 present Mutual Fund Day, Mission Prosperity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back to this special show, Reliance Mutual Fund Day Life Hacks. We are in conversation with a panel of experts to help you get the right retirement solutions. Okay, so Harsh, for now, let us leave aside the physical assets. Let's leave aside real estate and gold and focus on the financial assets, the options that we have, which is fixed income as well as equity. Now, obviously, if you've retired with a huge amount of money, you probably don't need much equity because you just live through whatever you've generated. But otherwise, realistically speaking, is there a thumb rule to this? Is there some sort of a upper limit which you shouldn't breach with respect to equity, or how does one decide how much should go in equity funds, how much should be FDs or balanced funds for that matter, the asset class mix?
So I still do not know of anybody who has got a lot of money at the time of retirement, because our needs are always evolving. So it's always good to assume that you should have an appropriate amount that helps you live through retirement. Now, another myth that people have is that, equities is not for people beyond 60.
Yes.
That's not true. Why? The reason being because if you, for instance, you have got a large corpus in your hand, for example, which is sufficient in our terms to, help you live all through a retirement. In that case also, beyond a point, I mean, when you have visuals of yourself, you think that up till 10 years, I don't think I should have a problem. But what about the costs after 10 years? Yes. The interest rates, we are in a reducing interest rate scenario wherein I do not think we will be able to generate enough just in the form of interest income.
And post-tax especially, I mean, not the most tax-efficient instruments.
Yeah,
we're looking at traditional savings instruments.
Absolutely. So, which already the people who are about to retire now are going to face it. I mean, you're going to see a scenario where you were earning, say, an 8% on a fixed deposit. Now it's come down to about 6.5. So, the corpus is constant and the cost of living is going up. So, you have to have a hybrid model. Wherein, and you also have to know that you do not need the entire money right now itself. Though you have retired, your monthly expenditure is only what you need. So that is a small fraction of your capital. So look at 100 rupee that you have accumulated over a period of time. If that is your corpus, that's your 100 rupees. Suppose we have, you need only 1 rupee out of it per month. So why cannot that 100 rupee be invested in a hybrid product, which has some equity component, and it could be as little as 5% and it could go up to 70%.
Sure.
But that is your choice.
Sure.
Now that would depend on how much corpus you've accumulated, how much time do you want it to survive for you. So you can have a hybrid model because that equity component helps take care of inflation.
Sure. So to take that point forward, now that we agree that maybe some sort of a hybrid product would perhaps best suit the need of people who are retiring or who've just retired, Arun, should it be balanced funds? What kind of hybrid funds? Sort of how do you go about choosing the right product then?
So again, like I said, there are different products offering different, different components of equity. There are products which have only 5% equity. There are products which have 20% equity. There are products which have 35% equity. There are products which have close to 65-70% equity. Balanced funds fall in that category, right? So again, there is no one size fits all kind of a solution, obviously, right? somebody retiring at 60 could have already sorted out a lot of things. He is already having monthly income. Large part of his requirement is already taken care of. His way of investments can be very different. Probably he could go for a balanced fund having 65-70% equity as well. Someone else may be critically dependent, more dependent on this corpus to take care of his monthly expenses. It is required for him. Come what may, he needs that money. So he needs to be a little more conservative. Probably he may have to go for another product, probably with much lesser equity. But the moot point here is,
for example,
there are products like monthly income funds,
yes,
which have about 20-25% kind of equity, right? So these kind of products, while they give the stability of debt, they also have the potential of equity returns. And overall, they have the potential to beat inflation over a period of time, right? So that will be critical. Again, in the whole thing, I completely agree with what Harsh just said. It's very, very important to have some component of equity, because only with pure debt, in my view, beating inflation on a sustained basis and to kind of keep yourself going for the entire post-retirement phase, that's going to be difficult. So therefore, yeah. So, again, a follow-up here for those who are seeking monthly income, because that's an important thing when you've retired. What are the options that, the MF industry can throw up? I can think of, for instance, systematic withdrawal plans, the monthly income plans that you mentioned. Anything else? And again, if you could just help us understand what sort of product or what sort of a mechanism might suit what sort of an individual. Yeah. So the first step is determining how much equity debt and accordingly choosing different types of
right
products.
Hybrid model.
And within that the different funds and all that. So once you've done that, the monthly income is just a method of taking your investments out, right? So typically it is done in two ways. One, there could be dividends, and certain funds have certain decided frequency, like there are monthly dividend options, right? So one can opt for that. The only thing is the dividend declaration will be done by the respective fund houses. The scheme will decide depending on market conditions and returns generated.
So the quantum is not fixed. You wouldn't know.
You wouldn't know, right? That's number one. Alternatively, like what you mentioned, there is this feature called a systematic withdrawal plan, right? Which is nothing but I invest a certain amount, and depending on my requirement, monthly expenses or requirement, I systematically keep withdrawing. It can be monthly, it can be quarterly, right? So like I went back to this example. Suppose you invested 1 crore and you're fairly confident that this product can give you 6%. I'm just taking a number for example, right? You're fairly confident that you're going to get 6 lakh rupees in a year, 50,000 rupees in a month, right? So you invest 1 crore and you withdraw 50,000 rupees every month, right? So that's going to take care of your monthly expenses. The return may, let's say, go down, go up, etc. But eventually you're going to be assured of this 50,000, and ultimately if the product is going to give you 6% return, your overall requirements are taken care of. So that's a way of, and 6% was just a kind of anecdotal number. That return could be 8%, it could be 10%. That entirely depends on how much equity and how the market
product that you've taken in the market conditions. Harsh, your thoughts on the same? The best monthly income generating option that someone could look at perhaps, and also something for the other camp. I mean, people who are really fortunate, who've got other sources of income, who do not need monthly income from their investments. Then what should they do? Simply go for balanced fund, more equity, or what's the advice to them?
So let's look at the scenario one, wherein a person wants regular income out of the corpus that he's accumulated at the time of retirement. So there are a couple of options. One is that you put in a fixed deposit kind of a scenario, where you have a fixed interest coming, and then with that you try and live, or you meet your monthly expenditures. The other is, suppose you had a 1 crore rupees. So you park that entire 1 crore. Okay, and you can choose a growth option in that. There is an option to take a monthly dividend, as we've already spoken. So you can have a choice as and when the fund house announces a dividend, you get that. But you do not know exactly what the amount is going to be. So what you do is you park that money in a, say, growth option. And you set up the systematic withdrawal plan. I mean, it's a very powerful tool. With this actually you can define how much money out of the corpus you want every month. Absolutely. So if your monthly expenditure is 50,000, there is no point in waiting at the mercy of the fund house to announce a dividend, and you don't even know what the dividend is going to be in the next year. So out of the corpus, let the corpus grow as it is. And out of which you withdraw a small portion of it, which is your monthly
exactly what you need and not beyond. The rest of the money keeps growing.
Absolutely.
Yeah. So before we take questions from the audience, gentlemen, I think this has been quite insightful. Any final advice or tips or any thoughts you'd like to leave our viewers with, Arun?
So final thought is, it's not as complicated, retirement. I think, people should consult their experts, financial advisors. Once they do it, enjoy their retirement.
Okay, that's great advice, absolutely. On that note, let's open it out to our audience and see if they have any points to make or any questions to ask. Anyone?
You have discussed everything about monthly income, but I just want to confirm again. I have got my corpus fund and I want just, like as you said, not fixed monthly income, but I want monthly income. I have got my corpus. It is quite a bit. So where should I invest? And it will be tax-free. That is also I wanted to know.
Okay, so I'm guessing you will say SWP, the three magic letters, Harsh?
No, not really. I mean, if I understand the query correctly, it's that you have a corpus.
Yes.
And you do not necessarily require a fixed sum every month, but you want some kind of money to come in.
Yes.
So, you could, in that matter, just put the money into a growth option of a hybrid product. Because you do not have a fixed monthly requirement. So what is the meaning of a hybrid product? You could have a combination of equity and debt. Now how much equity and debt, we'll need far more bit of information before we come to that equation. However, the idea would be to invest in a hybrid product. Do not set up any SWP for that matter as well.
Then simply go for the dividend payout. So as and when...
May not even necessarily be a dividend payout option at this juncture. Withdraw when you want to.
Okay.
So if in case you need money only, and you know that you're going to require in the next 15 days or 5 days for that matter, you know how much money you're going to require.
Yes.
So you put in a redemption request only for that much amount. So you may possibly at that point in time think of a dividend payout option and feel there's a Santa putting money in your account, but that's actually your own.
Thank you so very much.
Okay. Any other questions?
How do I reinvest the remaining money which is remaining after my monthly expense?
Okay, so if I understand correctly, there is some kind of inflow that you have.
Yeah.
And it is in excess of what your monthly expenditure is at present.
Right.
Right. So if this is a continuous source, I mean, if you are getting income which is far more than what you require at current stage, you must reinvest it back into two areas. One is to create a contingency fund. So one part of it will go into creating a contingency fund because you might not have any emergencies today. But this could come in the next 15 days, all you know. Yeah. So start building that contingency fund so that in case of emergencies, you can dip into it. Okay. The other element again is if you can invest it, say into a 100% equity fund, for example, because you do not need, there's surplus even today. So if you have some surplus and that goes in with a target of 10 years.
Right.
Okay, and then you put that money into a 100% equity fund. This will help you live the same lifestyle even after 10 years. When interest rates and cost of living, interest rates are going to come down and cost of living is going to go up. So the corpus is going to be, the requirement for corpus is going to be higher. So this can add as a feed-in to your corpus at that point in time. So these are the two things which usually a retired individual with an excess monthly income can do at this juncture.
All right, ladies and gentlemen, thank you so much. Thank you to our wonderful audience and to our experts for joining in today and demystifying some of those very important aspects related with retirement. Thank you for joining us and thanks to our viewers for watching.
Reliance Mutual Fund and CNBC TV18 present Mutual Fund Day, Mission Prosperity.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.